So I don't think markets bottom because people panic. I don't think markets bottom because we get to some low valuation metric or some price level in the S&P. Sure, that could get some people to start buying, but in a very simplistic way, I think markets bottom when the problem that takes the market down, the perception is that that problem's going away. As simple as, we just went through a potential banking crisis in the United States, and, markets bottomed when the government stepped in and made people feel that we're not going to have a systemic banking crisis and backstop deposits, and, do all these other facilities that have helped banks remain liquid. Back in last year, we were just talking about energy when gasoline prices, at the lows in the market in June of 2022, gasoline in the United States was $5 a gallon, a record high. As that problem started to go away, or as gasoline prices started to come down, the markets rallied because they viewed that that was the major problem in June of last year, and that major problem started to fade. So when we talk about market bottoms and sustainable new bull markets, there's always a sustainable housing rebound that corresponds with every one of those market bottoms. So this chart here is building permits on top back to 1960. And I've highlighted every single major market bottom back to 1960. And what you notice is that in all of them, housing data is doing a V-shaped recovery or is just starting to improve and trend higher. And so I don't look for panic to turn bullish. I don't look for sentiment. I look for a shift in the macro backdrop, because most of these downturns are a result of a recession, and recessions don't end until housing bottoms. And that's been a big topic of debate in the last few months, because in the United States, mortgage rates are off their highs a little bit. We've seen some improvement in some housing data. Housing stocks have performed quite well. And that is stuff you have seen literally near the end of every Fed tightening cycle. And so on the cover of my handout, we have these news clippings from history showing how investors always believe there's a soft landing, because when the Fed is done, mortgage rates start to come down and housing data bounces. But the difference between a recession and a soft landing, again, goes back to employment, and whether or not employment takes housing down, the whole economy down, ultimately is the question from here. And that's why, I believe it will. But this chart here of the NAHB index, which is a series of home builder sentiment, what you can see here, and I'm plotting it with the Fed funds rate on the bottom, is that even in recession, housing data, or before a recession starts, housing data bounces every time. So we would be very, given our forward-looking indicators, we wouldn't be chasing the no landing or recovery narrative here. We think this is a bounce, a head fake, not a sustainable bottom in equities or the economy.